G'day everybody, welcome back. Well, welcome back to me as well as welcome back to you. I am very sorry that I have been slack. I had a 4-week trip to Australia in which I had an awesome time. I was meeting clients and partners and friends and family, and it was a really rewarding trip. But the amount of travel and airports and hotels and moving around, it actually really made it quite difficult to have my normal sort of content flow for you. So anyway, I am now back in Cyprus. And I'm back on track. So I have a podcast booked back to back over the next several weeks. So you can expect us to be back into our normal fortnightly rhythm. And I know I've also done, by the way, a lot of solo episodes. And whilst lots of you probably like the solo episodes, I know you also like hearing from guests. It gets a bit boring listening to Sean Steele all the time. So today I want to invite Sue Hirst, who is the co-founder of CFO On-Call, onto the show. Why? CFO On-Call have a whole team, like 17 virtual CFOs. And with all the founders that I support, there's not a single founder that's past 1 or 2 million that I do not recommend gets a virtual CFO. And actually, I was just speaking to a client yesterday who gave me such a good example of why it's so important. You know, I had a founder who'd hit about 12 million. Profitability had really waned. So normalized EBITDA was maybe 700K on 12 million. Actually, operating profit before all of their add backs was actually about 100 grand off 12 million. So not very much. Now, in that circumstance, what you need immediately is really good financial knowledge. You need the ability to get into the numbers, look at every supplier, look at every customer, analyze profitability per customer, per product, per service. You need to dissect everything 1,000 different ways. And you need somebody who's got the mindset, who's also got access to the right data, who's got confidence where you've got confidence in your financials and what you're being told, so that you can optimize. Without that, in that process, that founder managed to get from $100,000 to $1.8 million inside 12 months. That is a massive turnaround. And I guarantee you that would not have happened without that virtual CFO in place. That's just one example as to why they're so important. But today, what I wanted to do was chat to somebody who understands the world of CFOs better than anybody, a virtual CFOs, which is Sue Hirst from CFO On-Call. So today is about who's a CFO, what do they do, what don't they do, where do they fit, how much they cost, all of these things. And so that you can have a think about whether it's now or sometime in the future, should a virtual CFO be part of your organization to be an adjunct to you when you're not in the position yet or not sort of sizable enough yet to have your own permanent head of finance or virtual CFO. What are they good at? What aren't they good at? What makes a relationship work? Who's not suitable for a virtual CFO? And you can use this process also, if you have one, to be thinking about, well, am I getting these things from my virtual CFO? And if you're not, maybe it's time to ask some questions. So, thrilled to invite Sue on today. I'm sure you're really going to enjoy this episode. Give it a listen, and I'm sure you'll find it valuable, and I will see you again in another couple of weeks. See you soon.
Welcome to the ScaleHQ Podcast. I am Sean Steele, and I'm a growth mentor, digital nomad, a massive metalhead, and the founder of ScaleHQ. And you, more importantly, are a founder of a 7 or 8 figure services business who is finally ready to get serious about scaling up or securing a step back from your business or a life-changing exit in the next 3 to 5 years. And if that's you, then you are in the right place, because with over 100 million in revenue growth across my last 4 companies and many acquisitions under my belt, I have spent my whole career figuring out what makes businesses more valuable, scalable, and sellable. And I've learned a couple of things, and I'm thrilled to have an opportunity to share those with you today. So welcome to your fortnightly dose of practical strategy, founder success stories, and expert deep dives to help you finally get a return on all that sacrifice that you've made in your business. Welcome to the show. Let's dive right in.
G'day everybody, and welcome back to the ScaleHQ Podcast. You are going to love today's episode. I am absolutely privileged to be joined by Sue Hirst, the co-founder of CFO On-Call, which are basically a team of virtual CFOs or CFOs and financial controllers, and they help business owners with all the things that you would hope a CFO is helping them with: profit, cash flow, value, financial strategy, working capital, all the stuff that as founders, if you've never grown up in an environment where you've had access to a CFO, you get amazed by how much they know and how much you didn't know in a really positive way once you actually get access to the brains of a great CFO. And so today I really wanted to chat to Sue to understand and unpack the world of, and I'm going to say virtual CFOs as a sort of general term, because most of our founders that are listening are, 1 to 30 million. Not all of them are at the stage of having a role ready for a permanent CFO or maybe even a permanent head of finance, but they do, usually once they've got past a few $1 million, they do need the skill set of a virtual CFO. And so part of the reason for our conversation, Sue, is I'm constantly being asked for virtual CFO referrals as I do the work that I do. And just as recently as yesterday, I was chatting to a founder about the impact of a virtual CFO that I introduced in end of 22. And since then, that founder had turned around their profits from $100,000 to 1.8 million inside a 12-month period. And they needed the help of that virtual CFO to do all the financial engineering, all the profit optimization, the COGS work, the procurement work, all the stuff. They couldn't have done that without that support. So I know the value of virtual CFO. Today, I want to unpack what it looks like, some of the challenges, how to find one, how to find the right one, all those sorts of things with you, given your background. How does that sort of sound as a bit of a frame for us today?
Wonderful. Thank you for having me along, Sean. It's great to be here.
My pleasure. My pleasure. Now, if you are keen to step your business up to the next level, like by taking on an investor or stepping back and installing management so that you can enjoy dividends and get out of operations, or perhaps you want to secure a life-changing exit in the next 5 years in your business, well, whichever one of those three things you want, you are going to have to really think about what you prioritize over the next few years, because it's going to matter a lot as to whether you actually achieve those or not. And that's why you're going to love my Scale Scorecard that I've developed. It is a new diagnostic tool which I'm making available for free so that you can figure out where you're at right now and what you should focus on next. But it is not some made up fluff that I read in a book. This is real world scaling, investments, exits. If you would like to maximize your chance of securing that step up or the step back or the step out, then come and find out your scale score at scalescorecard.com.au and click the button to take the quiz. Well, maybe we could start with, it might be easy for you and I to assume that everybody knows what a virtual CFO actually does and how it's different. Particularly, every founder here that might be listening today has an accountant. No question. They've all got an accountant. They've got some kind of an accounting firm that's doing their books. But of course, many of them might be stopping at the point of the compliance side of their submissions and their annual returns and so on. Tell me how it differs. Like, what are the kind of key things that actually really differ a CFO or a virtual CFO from a good accountant?
Yeah. Well, I suppose there's a bit of a gap generally in between what a bookkeeper does and what a typical accountant in practice does. So bookkeepers obviously keep the books, are quite transactional. So they are, keeping a record of all your transactions, your invoices and payments and things like that, and reconciling things. And your tax accountant generally is looking after tax and compliance related issues. So there's often quite a gap in the middle there that relates to financial strategy and clarity. So I suppose we're about looking through the windscreen rather than the rear vision mirror. So, when businesses get to a certain size, just dealing with what comes in and goes out really just isn't enough. If you really are serious about growing your business, then you really do need to have the numbers all plotted out in black and white so that you've got clarity over exactly where you're headed, what your targets are, and more importantly, how you're going to get there. Because one of the biggest issues we find with growing businesses is that their growth is often quite unplanned. And that can tend to bring with it unexpected problems, So people tend to have a thinking that, well, if I just sell more stuff, surely that'll all be fine, won't it? Won't it all just end up on the bottom line? But the fact is it doesn't, You've got to take into account a bunch of other factors as well as the sales side of things, because whenever you sell something, you've got to buy stuff. And so the more you sell, the more you got to buy. And the more overheads you incur, if it's taking time for your customers to pay you, then that means you've got more debts outstanding from customers. You've got to buy more stuff from your suppliers, so you might be having to pay them sooner than you're getting paid by your customers.
Which essentially turns you into the bank for your customers, doesn't it? Like all of a sudden.
Exactly. So if you don't plan all that out, growth can often go a bit like that. where a business
Yeah,
falls over because they hadn't planned the growth.
one of the things I see, so just a couple of things I wanted to draw on from there that you said. First one is the rear vision mirror versus the forward looking. I don't know what the best analogy is, but that is probably, to me, one of the most easy distinctions between the stuff you get from your accountant. You're always looking at the past and maybe telling you how things were, but there's limited conversation about the future, maybe about structure for the future, possibly depending on the accountant, but actually your ability to make decisions about the future is super limited because that accountant's not doing any financial forecasting. They've got no financial models. They're probably not doing your cash flow. There's probably no budget. And so that's kind of that sort of forward-looking versus rear-looking I see a lot. The second thing that you mentioned in the context of growth, that it's often unplanned, and that is completely normal and natural in the early days, but sometimes we don't shift out of that model fast enough. So I've worked with numerous founders in maybe the sort of 5 to 15 million space, and often they hit like 8 to 10 to 12 million. And when they were at 5 million, they were very healthy and profitable. They might have been doing, 30% profit margins. And actually over the previous 5 years, they may have even doubled in revenue, but actually their profit hasn't moved because they're constantly just reinvesting in growth. And then all of a sudden they turn around and they're like, I'm working twice as hard. I've got twice as many people. I've got twice as many customers, but I'm actually not making any more money. What is going on? And that's such a great example of the unplanned growth, the sort of not being able to be deliberate or scientific enough about what you invest in, when you invest in, and even at a customer level. The founder I was chatting to yesterday, when they were looking at their bottom line of $100,000 after, and this is a $12-13 million business, they looked at their customers and they had a whole bunch of customers that weren't profitable, and they were still serving them and working weekends and working nights and everything to serve these customers because they'd always had a brand of good service and all the rest, but actually those customers weren't profitable. And so part of their decision making was, which customers are we going to move on and which customers are we going to focus on, because actually there's no point serving these customers. So those are really hard to do when you don't have someone who can help you be objective and help you analyze and help you model the impact of different decisions, I think, which is a huge value points.
And also getting the systems in place to be able to know that. I mean, that's one of the biggest issues we find, is that the systems just don't keep up with the growth. And therefore, you have businesses flogging their guts out, selling stuff that, as you just said, is not returning anything onto the bottom line. And worse still is taking time and resources away from the good customers who are profitable. And so, if you know that, then that really helps you to capitalize on that situation, doesn't it?
And maybe one of the founder mindset shifts that sort of happens or needs to happen that changes how you think about the information that you need is often founders, when they're kind of growing up to 10 million, aren't yet thinking like a shareholder. They're just thinking like an owner, like, this is my business, this is my baby, I just need to serve my customers and that's how they got to where they got. So it's not like it's a bad thing, but at some point you have to shift to a shareholder mindset and say, okay, this is also an asset for me. Am I actually getting a decent return? How is this thing going to create value in the future? Am I getting a real return on both effort and investment? And all of a sudden you end up with these questions that come from that, but often that you can't answer if, as you said, the data's not structured in a particular way to be able to gather the insights, answer the questions, and virtual CFOs they can't answer those questions unless they help you get those data structures right between your CRM, your finance system. Maybe you're still cash accounting, you're not even on accruals. Maybe your CRM and your finance platform don't link, and so all of a sudden no one's got answers. But now you've got someone that can actually help you get the answers. What are some of the things that you see as like, either that you see or that you hear, that are often triggers? Maybe it's things that people say before they come to CFO On-Call and say, hey, I'm really looking for a virtual CFO. Like, what are some of the things that you hear that are like the warning signs or the trigger points that make them want to search for one?
Well, I suppose when business owners are in the process of growing, so growth happens naturally, as you said before, and so they start to get a sense of they struggle with the resources and with coping with everything, and you mentioned there about them changing from being business owners to a different mindset of being a shareholder. But what we often find is that they also need to change and get off the tools. Quite often business owners start out because they're good at what they do, and they tend to get a little bit stuck into the being on the tools side of things. So they start to experience stress themselves, trying to do everything and be everything and answer everybody's questions. So there's a bit of stress there. And with the funding that's required, so quite often you'll see cash flow squeeze in growing businesses because, as I said before, when you sell stuff, you need working capital to handle the cash flow cycle side of things. So when I say that, I mean waiting for your customers to pay you and paying your suppliers and paying your overheads. So if you need cash to fund a sale, the more sales you make, the more cash you need. And so that's a phenomenon that's not often understood by business owners. And there's a term for it. It's called growing broke. And we see it quite often. And it's quite easy to fix. Once you know what you're dealing with, and you can sit down and logically look at it all in black and white and plan it out, then it just needs to be dealt with properly.
I'd also say, just sort of on that theme, that when you're at the stage, if the business is going well and your cash flow is getting squeezed and you don't really understand the mechanics of why, and you need some kind of working capital solution, whether it's invoice financing or overdrafts or whatever, it's really difficult to have good quality conversations with numerous financiers without good information. So the virtual CFO sort of service there of being able to get the data in place, be able to intelligently talk about the risk profile of your business and what cash is actually required and when it's required, and to help you get the best terms, because not all terms are equal, and the riskier your business looks, probably the worse your terms are going to be as well. So actually it can really make a big difference, I think, having somebody represent you in those conversations as a founder, and to do that work for you to make sure you get the right working capital solution or right financing solution to fuel growth, if it's not just going to come from organic cash flow, which of course many businesses does, but others either may want to grow faster, or just based on the cash flow cycle, it may not be appropriate. Like they may not get very far and really put a lot of constraints on themselves.
Look, probably the major one is poor quality of the accounts. So the bookkeeping can be a bit questionable sometimes. Transactions haven't been treated properly, and so the reporting that you get from that is not accurate and can't really be relied upon for decision making. So I guess that creates a situation where the business owner is a bit lacking in confidence in the data for the decision making.
Yeah, and usually you'd see that by the founder kind of looking at the books, right, and go looking at their end of month report, and they go, I just know that it's not right. Like, I can't tell you exactly why it's not right, but I just, like, my gut tells me. And they usually have a good gut feel, don't they? They kind of know what it should look like, because they know how much money goes out the door, because they approve all the payments, and certainly in the early days. And when their gut says something's wrong, often it's in that end of month process, the way transactions are being coded, the way the end of month is being done, and therefore, that makes sort of poor decision making, doesn't it? What about, one of the things I'm really curious about is how, you've got a founder who's got a growth strategy. Where do you see the most important role of a virtual CFO in helping them turn that into a sort of financial strategy, or how their sort of financial strategy supports the growth strategy of the business?
Look, I think the most important thing really is helping business owners to be confident that their growth aspirations are viable and sustainable. So, before you head off and start producing anything or trying to sell anything, making sure that it is actually going to be a profitable exercise, and that that it is viable, because there's no point really in heading off and investing a load of time and money and resources into something that is really just not going to give you a good enough return on investment. So That's one of the most important things. And then once you've got that and you're fairly confident that it is a viable proposition, then the first thing really to do is a budget to make sure that you really understand what it is you're selling, what it's going to cost you to sell. This is one of the issues that we see very often, is that business owners don't really know the true cost of their product or service. And therefore that makes it quite difficult to price it right.
Yeah.
So they'll head off and just start selling stuff and trying to compete when they're not really sure whether the price that they're charging is going to cover their costs. And they don't really know their competitor's situation. They may have a completely different scenario to you, and they may be able to sustain that pricing where you can't.
Yeah.
So, you really do have to be certain that that your pricing is going to cover your costs.
That's actually a great example, right? You, as a founder, you might just look around and see what your competitors are charging and go, okay, well, I'll just pick the midpoint, or, pick the top quartile or something, and what everybody else is charging, that should be fine. But yeah, if your cost base is different, then their entire team might be offshore. They might be doing technology way better than you. They may have purchasing power you don't have. Like, there could be a whole bunch of things that reduce their costs of goods, and therefore their GP is higher and yours is much lower, but you haven't really either thought about how you're going to cost that, or perhaps considered the cash flow impact of the way you've priced it, or the payment terms that go with the model between, upfront and recurring and a million other things, and all the way that costs are going to land. I actually think that's a really interesting example of one of the insights that I'd love to just give you to hear some examples from you of the kinds of things, recently, from your, you've got a big group of virtual CFOs. How many virtual CFOs are in the group now, Sue?
Well, I think we've got about 16.
Okay. So between 16 virtual CFOs, I'm sure you hear all sorts of examples of things that they've sort of discovered for a founder that creates value that an accountant is definitely not likely to see, or a bookkeeper's not likely to see, or even a management accountant internally is likely to see. What a couple of examples, because I've definitely got some that I can share too. Love to hear yours.
Well, I can give you a very recent one, actually. Quite a new client dealing in the fashion industry and doing a lot of e-commerce and trading overseas had, I can't remember the exact number, but it was quite a few different bank accounts, maybe 7 or 8 different bank accounts, and some of which were in different currencies. So up until having a CFO on-call involved, they didn't really have anybody who was analysing all of that and reporting on the real situation. And so the CFO was able to quite quickly go in and plot that all out in a spreadsheet, do all the currency conversions, amalgamate all these bank accounts, and give them a very definitive Australian dollar figure at the bottom. So they knew exactly what their cash flow position is. And they were absolutely gobsmacked because they'd never had that before. They were just literally flying blind.
In terms of the fees they were charging and the sort of exchange rates versus alternatives, in terms of like how much
how much cash they had.
Yeah, right.
Just how much cash they had to do things, to pay for things.
Okay, yeah, right.
And not a small business.
No.
Not a tiny business.
No. I saw a founder recently who's got a $20 to $30 million business, so not immaterial size, done a great job, and they were bearing the credit card fees for their customers. That credit card fee is like 1.5% to 2%. Well, 2% on a $25 million of credit card transactions is what is that, like $400,000?
That's a lot
the
of
bottom
money.
line. And so one tiny change they made, that 1.5%, which is now being paid for by the customer, which didn't have any impact whatsoever on volume or transactions or conversion rates or anything, and they put $400,000 back in their bank account each year, which multiplied by their actual valuations, probably about $2.5 million of business value in one decision in a moment. But again, that sort of financial optics at looking at some of the detail made a big difference. What are some other examples? Any others that recent ones in your mind?
I'll see if I can get this one right. So this was a business that they wanted to grow their revenue, and they needed to do quite a large investment in equipment.
Mm-hmm.
The growth plans that they had to begin with, they plotted out that they would grow their overheads in line with the revenue growth, when actually, when the CFO looked at it, he said, well, you don't actually need to increase your overheads in the same proportion as your revenue growth if you implement some new systems. And so he plotted out for them, if they invested in a new ERP system to automate a lot of their activities, whilst there was a reasonable investment, I think it was maybe a few $100,000, and we're talking a business turning over tens of millions of dollars, that would literally keep their overheads the same.
Yeah, wow.
So I think it made a difference of something like about $500,000 in their profit figure.
Yeah.
So, and this is an issue we see quite often, is that people are a bit hesitant to invest in systems and, invest the upfront cost or find a way to fund it until you actually plot out for them what that is going to return in the future.
Yeah.
And, on top of being a huge increase in the profit figure, it massively increases the value of the business.
Yeah.
Because the profitability from that point on, you've got that profit forevermore, and you've got those systems in place in your business, which makes it so much easier for a new owner to come in and run that business.
There's another couple of perspectives on that same topic, which is when founders are growing and without someone like a virtual CFO who tends to be quite objective, not as, by their nature, pretty objective, pretty good at getting perspective, looking at the whole business from sort of the outside, even if they're an internal resource, or if they're a virtual CFO, then obviously they're sort of fractional. But helping you see those things that you may have normalized as you're growing the business. So for example, as you said, okay, well, I'm trying to grow my top line at 20%, so my OPEX is going to grow at 20% as well. So I just need more people. I just need more salespeople doing that thing, more customer service people, more admin people. And so one thing that happens is you can end up with a business that's materially more with no more profit, but it's not just the lack of profitability. It's how it makes you feel as a founder. When you've got a lot more pressure, you got a lot more to lose, and any small, movements in the market, retractions, loss of customers, whatever, has a bigger impact. And now you've got a much bigger cost base. It's actually a much more stressful existence when your profitability is waning, and is not quite there. And you're growing because you've kind of normalized, I need people to do this stuff, rather than, okay, maybe there's a technology investment. And the thing that I think the role here, the reason I'm sort of laboring on this point is what often happens in technology projects that I see, and I've been absolutely a culprit of in my previous career and kind of growing up and doing some big technology implementation, CRMs and contact center suites and all sorts of stuff, is in the absence of someone like a virtual CFO whose job it is to make some kind of metric move. That might be how long it takes to do a task, or how many people are required to do a task, or whatever the sort of, you're making a systems investment usually because you want some particular metrics to move. But what usually happens is you craft the project, you get the project done, and then everyone's like, hooray, the system's implemented, and you move on to the next thing. And nobody's looking at, did the metric move? Did the thing that we were trying to actually achieve at the end of this actually get the outcome financially, operationally? And CFOs are really good at that. They're thinking about, how does that metric move? And if it's not hitting the financials, the project is not complete until we've actually embedded the value it was supposed to deliver. And sometimes we're in such a rush and so focused on growth, as most founders are, that we miss those things. And therefore technology implementation sometimes are poorly executed and money is wasted. Virtual CFOs can do a good job, I think, of helping them be more successful.
Yeah. And that's where your non-financial KPIs come into it, isn't it? A lot of accountants will say, oh no, I can't I can't help you increase revenue. Well, that's rubbish.
Mm.
If you're that's what a CFO does.
Yeah.
They say, okay, how do you make money here? What are all these operational things that go to make up your revenue? And what's coming down the pipeline?
Yeah.
Really, that's what it boils down to. How many leads are you getting? How many inquiries are you getting? What's your sales conversion rate? All those sorts of things. Because if you can just tweak those a little bit, you may not have to make any more sales. If you can improve your sales conversion rate, then, all those sorts of non-financial KPIs can have a massive impact on revenue and profitability.
Yeah, I like that, because I think this is when I see founders get squeezed, and there seems to be a real threshold somewhere around like the 8 to 12 million mark, where founders, where their cash flow gets squeezed, where their profit gets squeezed because they've been just investing ahead, just focused on growth, adding OPEX. And it's this, at that stage, there's a whole bunch of low-hanging fruit. It might be wages that you don't need. It might be that your COGS are wrong and you need to, do some procurement work to get your pricing down. It might be that your conversion rate's slightly low, like the ability to have a virtual CFO, do the diagnostic and go, a 5% change here, a 10% change there, a small pricing uplift with these customers, like all of a sudden you can go from, no profitability to 15% profitability in the matter of months. But someone needs to help you look at those sort of leading and lagging indicators to go, which is the drivers here? Which are the ones that are going to have the biggest impact? Pricing is such a unbelievably perfect example. I've been chatting with a founder recently who they know this, but it had just been sort of sitting there bubbling away in the background because they didn't really have anyone looking at it. They hadn't changed their prices in, I think, 3 or 4 years. And in that time, the market had moved about 25% on average. And when they did the analysis, they could actually move their prices by 25% with not a single dollar more in cost of goods sold or OPEX. And that would have added, or that will add about more than $1 million of EBITDA in a matter of sort of moments. But again, we're so focused on growth and the team and culture, we miss these things when we don't have somebody sitting along as a co-pilot alongside us to sort of shine a light on those missed opportunities.
That's exactly what the CFO does. In fact, we have an example of that. One of our CFOs went out to visit a client, and one of the first questions he asked them at the first meeting was, how long is it since you increased your prices? And they said, years. And he said, why? And they said, well, we just hadn't thought about it. And he said, well, would you like me to do some analysis for you on which ones I would recommend that you increase? Because it's not just across the board always. And it wasn't a huge business. I think they were only turning over about $1 million or something. And he worked out, a sheet based on a schedule on what they could increase and what they could. I think they were a wholesale plant nursery or something like that. And this price increase would put $20,000 straight onto their bottom line. And so they did the increases, absolutely no resistance whatsoever. They were so shocked that such a simple thing that they just had not considered what a huge impact that would have.
We're always scared that the customers are going to leave and the volume is going to fall off a cliff and all the rest. And part of that is often that we're running, it's the fear, number one. It's the lack of skill set to do the analysis or to take the time to do the analysis.
And also to understand your own unique selling proposition. The question always is, if you're scared of losing customers, where are they going to go? What are your competitors like? What advantage have you got over your competitors? And do you make the invisible visible? Because a lot of times business owners, they're so passionate about what they do. They do a fantastic job that they just take for granted the extra care and attention that they take to what they do, and they don't tell customers about it. They just take it as a given. So it's a huge marketing opportunity, actually, to make the invisible visible.
I think a great example of that is generally in a services business, there's often very little differentiation on the what. Like the what you do is probably the same as the 10 competitors that are most likely to be chosen over you. But how you do it is fundamentally how you differentiate. But how good you are explaining the how is where marketing plays a role, and where your price differentiation can be supported. And if you think about it, a services business, and I deal with a lot of services businesses, people are usually paying and will pay a premium for a proprietary process. Like that's ultimately what they're buying. They're buying your approach to solving a problem that is in some way likely to produce a better outcome than somebody else's approach to solving the same problem, because it's a service. And how good are we at sort of describing our proprietary process and how it makes improvements? Like I think about one of the largest labor, old friend of mine runs one of the largest labor hire businesses in the country, like, $500 million of revenue, like huge business. They had engineered their recruitment process to such a sort of fine level, like to put in all these gates to make sure that the people that they recruited for labor hire and placed them with a client were the absolute best quality they were perfectly prepared. They were exactly what the person needed. They rocked up professionally. And every time it produced a good sort of, person on the other side of a process. But actually that process is what the client is paying for, because they could go somewhere else and maybe find somebody else who could do the job. But is it going to be the same level? No, because they've got all these gates. And that's a great example of they can differentiate on price because of the process, making that invisible visible.
Well, that raises the issue of a fantastic marketing opportunity of a return on investment calculator, doesn't it? So if that business were to work out, okay, what's our failure rate? And if it's very small, put that in, compared to our competitors' failure rate, which they may or may not have accurately, but they might have some anecdotal evidence, and put that into the calculator and say, well, here's what the difference is worth.
Yeah.
And it's way more than the differential in our pricing.
Yeah, that's super interesting, actually. Yeah, so you could almost take that as a...
And that's the sort of thing CFOs are very good at, ROI calculators.
It was making me think about let's say you've got, everybody wants to say they've got the best quality. We're high quality, blah, blah, blah. That's great. But what's the substantiation? Well, actually, let's just say it was even on Google reviews or a customer satisfaction metric that it was actually public. Like, I don't know, you both publish your NPS data and you both got Google reviews or something. Actually, you could almost quantify that, couldn't you? You could say, well, we've got 100 reviews at 4.9 out of 5. They've got, 50 reviews at 4.3 out of 5. Let's talk about the impact of well, I don't know what that is in difference. Maybe it's 25%. That means 25% of their customers are unhappy. So let's talk about the impact of that on your likely outcome. You get 25% risk, so you've got a 1 in 4 risk now that you're going to get a poor experience. Well, that's why we've got 4.9. This is our process. This is why we charge more. Yeah, it's a really interesting way of justifying a proposition. I like that. I'm conscious of how much time we've got today, Sue, and I know that everybody listening is like, oh my God, I mean, this is just a full sales pitch for virtual CFOs from Sean. Thanks very much. But clearly, I'm passionate about it because I know the impact that they have on the founders that I work with, and there's no founder that is past $1 million that I think should not have a virtual CFO in some way, shape, or form. So I want to chat to you about just what does a typical engagement look like, typical pricing, that kind of thing as well. But before, if I sort of flip the model, where do virtual CFO engagements fail or not create value? Like, what can go wrong that would help our founders think about, like, how to, I guess, get the most out of virtual CFO? Can you give me some examples of where you've seen engagements not work or not create value, and like what's gone wrong?
Well, I guess probably where the business owner is not committed to the process. So, because it's really a relationship business. We become their financial co-pilot.
Yeah.
So to make a difference, we really need to be part of the team, although we're not there full time all the time. It's an interesting term that I always remember one of our CFOs once telling me that he thought the best type of clients that he could work with were people who are teachable. So people who didn't feel like they knew everything, and that's why they could see the value in having a CFO involved, and were willing to learn about the mechanics of the numbers, because it's not just so straightforward. And we understand business owners haven't got the time to go and do an accounting degree and understand things like debits and credits and accruals and all those nasty words that nobody likes to hear. But, they have an impact. And if you don't understand them, then that's where you can really come a cropper.
That's interesting.
But
Yeah,
one
I think
of the
if I just
I think you asked there for an example
yeah, if you go on, sure.
of one that didn't work out,
Mhm.
and this is in the last year or so. We had a client who we'd only just started working with, and really fantastic potential for this business to grow. But the problem that we encountered when we started working with them was that the partners in the business were not aligned with each other. So there was, in fact, not only were they not aligned, but there was quite a bit of conflict going on and white anting and things like that happening in the business. And so, despite our best efforts to try and even facilitate and mediate that situation, because we could see that they just had so much potential, but that just could not be overcome. And so in the end, we just had to walk away and say, look, guys, love to help you, but until you get that sorted out, we're really shoveling the proverbial uphill here. See if you can sort that out and let us know when you have.
Yeah. I was just thinking through. It was making me think through situations where I've seen founders engage virtual CFO and either cease too early or not get the value that they were looking for. And I think in most cases, it's been the assumption that they're going to get, like they might have a mess in their financials. And so they want return on investment straight away. And, virtual CFOs are not the cheapest resource in the world, but that's because you're paying, they're experienced people who've got a lot of knowledge and wisdom, but they're absolutely worth the weight in gold. But as you said, if you don't allow them the time to actually get a good understanding of your business, get your financials in order, get data that actually starts to support you, then they can't actually create any value. And so you might have more of a mess than you think. And if that takes 3 to 6 months actually to clean up the way that your balance sheets are being, reconciled, or your end-of-month processes are working, or the way your data is integrated between your core CRM and your finance platform, or whatever is required, then it's pretty hard to expect genius maneuvers. Maybe that's an opportunity for virtual CFOs to do the analysis and focus on pricing first to create immediate value, and then move on to the stuff that the founders think are boring. But they're important, and you're not going to get very far until that work is done. Otherwise, you can't actually create any real future visibility or any good sort of financial platform for decision making. So I guess my last question for you,
look,
then,
we obviously we encounter those situations quite often where the accounts are in a bit of a mess, and depending on how busy our CFO is at the time, they will sometimes they're happy to roll their sleeves up and get elbow deep in it, because it actually gives them a very good understanding of how the business works, and we generally make an adjustment to the fees that we don't expect to be charging, high fees for reconciliations, or we'll employ some additional resources to help us sort it out, but under the guidance of the CFO, who knows what they're looking for and what needs to be fixed and how.
I think that's actually a point that we probably haven't talked about is, when you're a founder, you kind of have to know enough about each area of the business to be, in my words, to be dangerous. Like you need to know enough that people can't pull the wool over your eyes, but you're never going to be an expert in any of those areas other than probably product and sales, because that's how you built the business in the first place, and sort of delivery. But how are you going to develop your people? So it's hard to give guidance to, financial people around their end-of-month processes and so on if you don't really know what that is. And so I think that's actually one of the undervalued benefits is you've got the opportunity to get guidance from somebody experienced in actually leading your team in the most appropriate way. Or if you actually want to outsource more of your team, I've seen virtual CFOs have their own team in the background that's not your internal team and actually do more of the service. They stay strategic, but they get their own bookkeeper, they get an analyst, they get whatever's required for you, and you kind of have an outsourced team, not just a fractional CFO helping your team succeed. But I think that's quite a nice way of accessing the seniority without the full-time paycheck when you're not ready for that sort of full-time CFO. I think that's an interesting upside.
Yeah. And look, I think that's where a good CFO really can help the business owner, not by trying to teach them how to be an accountant, but what they should be looking for as a business owner, the numbers that they should be looking at. And if they've done that budgeting and forecasting, then they know what their targets are, and they'll see pretty quickly where things are off track or incorrect information has been provided.
Yeah.
So, as I said, the CFO is really a financial co-pilot, but helping the business owner to understand what sort of numbers they should be looking at and looking for.
That makes a lot of sense. Sue, I'm conscious of our time today and people's attention span and ability to continue listening to you and I rabbit on about how great virtual CFOs are. But clearly I'm a true believer in the value of one, whether they are full-time and internal, whether they are fractional and outside your business. You're never going to scale a business well without good financial acumen, and your internal junior team and your external compliance accountant are not going to be sufficient. So I don't see many circumstances where you can grow, scale, and exit a business or step back from it without that skill set. At some point, you're going to need it. Whatever the right timing is a question mark. Depends on where the business is at and what challenges. But anything that you would like to leave the audience with in terms of questions to ask themselves or comments that we haven't covered in any of the questions today before we wrap up?
Well, I guess it comes back to the whole return on investment situation, doesn't it? At the time it might sound like an expense, but actually in the long term it turns out to be a great investment.
Yeah.
And we have a term that we use it's in our sales process actually, called the pay for itself financial growth roadmap. And it's the journey that we set out with a client that can take however long the client wants to take doing it, depending on how, desperate they are for the growth plans. But in effect, the fees that you pay generally pale into insignificance compared to the outcome.
Yeah. And sorry, I did actually ask,
and in our
Steve,
case,
but I didn't follow up. Was what is a typical fee for a virtual CFO? And I know it depends, but like what would people expect if they're just entering an engagement with a virtual CFO? What would they expect to spend on an annual, monthly, or annual basis?
Well, it's a wide range. It obviously depends, because we've got some clients who are turning over $1 million and some who are turning over $100 million.
Yeah.
So the fees are obviously going to be quite different. But the average fee at the moment, I think, is running at about $4,000 or $5,000 a month. So, that would be maybe for a $5 to $10 million turnover business.
Yeah. Okay.
But, what they'd be getting for that obviously would be completely accurate information and timely reporting. And most importantly, interpretation of the reporting and discussion about it.
Yeah.
So, not just a business owner getting handed a piece of paper and there you go, make of that what you will.
Yeah.
What they get with the CFO is a really detailed conversation about what this information is telling us. And interestingly, I always remember doing a testimonial with a client, and I said, what is the best thing that you get out of working with the CFO that you work with? And he said, you're going to laugh at this. He said, I get a monthly kick up the bum. What he was talking about was accountability.
Yeah.
He said, we set all these plans and then we toddle off and start doing our thing.
Yeah.
And then by the end of next month, we haven't done any of it because we've been, busy doing business as usual.
Yeah.
But he said, what I get from John is accountability.
Yeah.
So he keeps dragging me back to these plans and goals. And what did we say we were going to do to achieve this wonderful outcome?
Yeah.
So, it's hard to put a price on that.
Yeah.
And also a sounding board.
Yeah.
Somebody to talk to who's not so deeply involved in the business as the day-to-day employees, who the business owner can be more open with, because you can't or tell everything to your employees or to your spouse or partner. You don't want to scare the living daylights out of them with everything that goes on in the business. But, with a CFO, you can do that because they're used to it. And they're
this is
not,
why,
day to day in the business.
And this is why virtual CFOs and I get on so well, because we're always the two most trusted people to the founder if we're external to the business, because both of us look at the whole business. We have very different skill sets and we can focus on different things. They might see, for example, the opportunity, what needs to be done, okay, like the pricing improvement, the COGS improvement, the get rid of these wages, whatever. That founder sometimes still struggles on the how to do that, which is where I come in and thinking about it in terms of the context of the overall plan. But both of us have that really privileged relationship as the sounding board and the safe place to be vulnerable and to go, I actually don't know what I'm doing here, and to be helped. So it's an incredible symbiotic relationship. And the other thing I would say on return on investment, I know founders are thinking, okay, well, if it's at like 50 grand or 60 grand a year at a starting point, well, I would certainly encourage founders to think about, if they were engaging a virtual CFO, to your point, or whether that's through CFO On-Call or it's another, independent provider or whatever, think about what gets prioritized in that first 12 to 18 months and look for opportunities, as you said, to have it pay for itself. I guarantee you, if you've got more than $1 million in revenue, you've got pricing opportunities, you've got COGS opportunities, you've probably got labor opportunities. There's going to be places that you are not optimized, wasting money, and that money can be put back in your hands very quickly and paid for by somebody who can help you think about it, analyze it, guide you on what to prioritize. And then obviously if you need help with the implementation, that's what I'm here for.
You'd be amazed where the fees can come from. One of the usual suspects is accounts receivable.
Oh, yeah.
We walk into businesses who have, like 80% of their debtors in over 90 days. And you just think, why?
Yeah.
Why isn't anybody chasing this? Why isn't this being handled? And, the money's just sitting there waiting to be collected. So more often than not, we can bring in several fold our fees within the first few months just by getting that sorted.
So thank you so much for sharing your wisdom and your time with us today. For founders who are listening, I hope, if I couldn't bash you over the head anymore with why you need a virtual CFO, I think we've done a pretty good job today between Sue and I. Obviously, if you want to reach out to CFO On-Call and explore their services, you'll be able to find Sue's details in the show notes. But regardless of who you choose to use, I can vouch for the impact that, when you think about the work that I do with founders, and the average results are over the first 24 months of working together are about $3 million in revenue, $500,000 in profit improvement, and about 2.7 in enterprise value. That in almost every not every circumstance, but in almost every circumstance, a virtual CFO has been part of the mix in supporting the founder to implement things that are actually helping them make those improvements. So if you want to drive your business to actual scalability, you want to be able to exit, you want to be able to step back, you need financial controls, you need good financial information, you need good working capital. Like it's going to save you a significant amount of stress and actually be a core enabler of you being able to get to where you want to go. So thank you very much, Sue. Really appreciate it, and look forward to get to know you and the virtual CFOs from CFO On-Call in the future.
My pleasure. It's been great being here. Thanks, Sean.
Lovely. Very welcome. Thanks, Sue. Have a great day. Cheers. Thanks, everyone.